Good day and welcome to the Q2 FY26 post-results conference call of Aarti Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this call is being recorded. I now hand the conference over to Mr. Nishid Solanki from CER India. Thank you and over to you.
Thank you. Good afternoon, everyone, and thank you for joining us on Aarti Industries Q2 FY26 earnings conference call. Today, we are joined by senior members of the management team, including Mr. Suyog Kotecha, Executive Director and Chief Executive Officer, and Mr. Chetan Gandhi, Chief Financial Officer. We will commence the call with opening remarks from Mr. Kotecha, followed by a Q&A session where the management will address queries of the participants. Just to share a standard disclaimer, certain statements that may be made in today's call may be forward-looking in nature. A disclaimer to this effect has been included in the results presentation, which has been shared earlier and also uploaded on stock exchange websites. I would now invite Mr. Kotecha to share his perspectives. Thank you, and over to you, sir.
Thank you, Nishid. Good afternoon, everyone. We value your continued support for Aarti Industries. We'll share the industry trends, key highlights, and updates from our Q2 FY26 performance. To start with, the external operating environment continues to evolve amid a complex geopolitical backdrop led especially by US tariffs on select Indian chemical exports. But I think despite these market pressures, we've delivered sequential growth, predominantly driven by proactive market diversification, smart investments in innovation, and disciplined project execution. We are actively using our integrated manufacturing and product portfolio strengths to further establish Aarti as a global partner of choice in specialty chemicals. The tariffs represent a near-term headwind for the Indian chemical sector, temporarily eroding competitiveness against European as well as Chinese suppliers to an extent. In response to the steep tariffs imposed by the United States, we also took steps to diversify and rebalance our export mix towards Europe, Middle East, and Africa. And also, we are recalibrating our US strategy to sustain long-term growth momentum. Over the medium term, we expect policy clarity and normalization of trade flows to restore a more balanced operating environment. While near-term challenges persist, long-term volume visibility remains healthy across most businesses. At the macro level, we continue to navigate the volatile but gradually improving demand environment and deliver resilient performance. Let me move to our financial performance for the quarter. Revenue stood at rupees 2,250 crores, an increase of 21% quarter on quarter, driven by improved volumes across key product categories. EBITDA surged to rupees 292 crores, making a 36% quarter on quarter increase, primarily fueled by improved capacity utilization and ongoing cost optimization initiatives. As a result, profit after tax was rupees 106 crores, an increase of about 150% quarter on quarter, reflecting improved operating leverage. And after factoring in the exceptional items that you may have seen in our published financial results, CapEx for the quarter was rupees 267 crores and is expected to be around rupees 1,000 crores for the year FY26 as guided earlier, reflecting continued capital discipline. Despite short-term uncertainties, we remain firmly committed to achieve our FY28 EBITDA aspirations and executing our strategic plan focused on cost optimization, volume ramp-led operating leverage, and monetization of ongoing CapEx projects. Now on key application segments. Within our energy-linked portfolio, MMA delivered strong performance in Q2 and achieved highest ever quarterly volumes, driven by spillover demand from Q1 as well as diversification efforts to various geographies where initial customer response was encouraging. US tariff weighed on volumes and margins, while renegotiations are underway as a proactive measure to secure and sustain future demand. On capacities front, we have achieved peak utilization of newly expanded capacities for MMA. We are in the process of executing various debottlenecking initiatives which will support us to scale up our volumes even further from Q4 FY26. MMA remains an important additive for blenders and refineries, primarily used to enhance octane ratings in gasoline blending. During the second quarter, favorable naphtha to gasoline spreads supported robust MMA consumption by blenders. Despite ongoing competitive pricing challenges from both China and domestic Indian players, our strategy focus remains on market expansion and development, growing the MMA customer base and sort of extending our geographic footprint globally. In agrochemicals, select products are showing promising volume recovery, although the overall margins remain under pressure. Demand growth in the dyes and pigment segment has been muted. Polymer business also faced significant headwind in the quarter as US tariffs impacted Q2 volumes. Meanwhile, the domestic pharma market remains stable, providing a consistent base. Overall margins for the company's high-value fluoro products are experiencing notable challenges due to sort of aggressive competitive pricing from China. The strategic focus across these verticals is on navigating these pressures on margins while capturing available volume growth. Looking ahead, a broader recovery is anticipated contingent on external trade developments. I think the successful negotiation of a potential India-US trade deal could be a major catalyst as it would likely provide crucial support for a wide range of products. Overall, we believe the chemical sector will see gradual recovery likely through the next couple of years as the global trade flow stabilize and pricing dynamics improve. In this environment, our focus remains on de-risking the portfolio, broadening the product base, and sort of strengthening our competitive positions through cost optimization and disciplined execution. Our Zone 4 expansion project continues to progress as planned, with newer capacities expected to come online over the next few quarters. New multipurpose plant within Zone 4 is expected to be commissioned in the Q4 FY26, enhancing the flexibility in product development. In parallel, the calcium chloride facility is expected to be commissioned in this ongoing quarter. As one of the growth project in forward integration, we are set to commission our new 4,000 tons per annum PEDA project at the Dahej. It will be in the Zone 4 in Jagadia, and it will utilize raw material from our ethylation capacity in Dahej. It will position us as one of the key domestic supplier, to support India's agrochemical industry and capitalize on the demand trend that we are currently seeing in the market. During the quarter under review, we have also entered into a long-term strategic partnership with DCM Shriram, who will serve as an exclusive supplier of chlorine from its chloralkali plant to our upcoming downstream chemicals facility at Zone 4. On the innovation front, we have intensified our R&D efforts in advanced materials, polymer chemistry, and other sunrise applications, aligning our capabilities with sort of emerging opportunities. As our current capex cycle concludes, I think the emphasis will shift decisively towards innovation-led growth and value-added chemistry in a more optimized manner. At an overall level, while the near-term environment remains challenging, the strategic priorities are clear. To broaden geographic footprint, diversify end-use application, and accelerate innovation in high-growth specialty segments. With key capacity additions nearing completion now and new products coming to market and strong progress on innovation, the company is well positioned to enter its next phase of sustainable growth. We remain committed to delivering our medium-term financial objectives and while focusing on creating long-term value for all the stakeholders involved. That concludes my initial remarks. I now invite the moderator to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. In order to ensure that management is able to answer queries from all participants, we request participants to restrict to 2 questions at a time. You may join back the queue for follow-up questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Arun Prasad from Avendus Spark. Arun, please go ahead with your question.
Hi, good afternoon, everyone. And first question is on first margins. We have seen the improvement in margins despite our mix going more towards MMA and energy products. Can you comment on any specifics, any other category which has led to the increase in the margins, and how sustainable is it?
I think margins improvement was predominantly driven by operating leverage. At a contribution level, if you see at the overall product portfolio level, we remain quite consistent on the contribution margin level. But as the overall business volume goes up, the operating leverage starts kicking in, and that starts getting reflected in the EBITDA percentage increase.
This is despite the slightly adverse mix we have seen this. So, safe to assume that when, say, probably the energy-related mix goes down, we will have a better margins going forward?
I've mentioned this in the previous calls as well. I think the portfolio across end application is now converging in terms of contribution profiles. So the variation across end application is not, significant. So at this point in time, what impacts more is the operating leverage rather than a shift from one end applications to other end application.
Okay, understood. Secondly, if you can just give a small recap on what are the likely plans which we are closer to starting in the next 12 to 18 months, and which will make a significant difference in our volume and our P&L. You can list out and give the milestones and approximate commissioning date.
So what we can say at this point in time is in this quarter, we'll commission a calcium chloride facility. In the next quarter, we are commissioning our multipurpose plant. Both of these are at Zone 4. In addition to that, in the next quarter, which is Q4 of FY26, we are also planning to commission a slightly increased capacity of MMA based on the debottlenecking effort. And in addition to that, one specific molecule, PEDA, again, which will become form of MPP. Post that, in FY26-27, every quarter, there are 5 blocks, incremental blocks in Zone 4. I think each of the blocks will get sort of sequentially commissioned throughout the next financial year. From a financials point of view, frankly, some of the products which are where the market is relatively well developed and it's more of a volume placement game, those will accrue to the bottom line relatively quickly. But many of the specialty products, especially coming from the Zone 4 blocks, they will take time to ramp up because that have to go through qualification cycles with the global customers. So there, the capacity utilization ramp up will take time.
Okay. And many of these projects, if you can also kind of give a very top view of, which end categories, because today we are almost 40-45% exposure to the energy segment, and the rest, and then agro is around 20. So at the steady state, say after all these are commissioned, any rough idea about, what would be the likely mix of the end category exposure?
I think we briefly touched upon this. If we look at our 3-year plan at this point in time, and of course it's subject to evolution depending on sort of given how volatile the situation has been in the recent years. But if you look at least from a strategic planning perspective, we feel energy will remain in kind of 30 to 40% range, and the share of ag polymer specifically, these 2 end applications, along with a little bit of pharma, will inch up, as we execute on our strategic plans. That is what is on the cards. How it evolves in reality, I think all of us will observe and see. But that's where we see kind of a resolved state at the end of 2.5 years.
Any preference on any particular? I mean, I'm not talking about the current ongoing projects, but going forward, strategically, do we want to say that we will focus on this category, and that's how we will be going forward? We will be putting the incremental capital allocation. Any such broad thoughts on how to think about the future capital allocations?
I think two things. One, from a future capital allocation standpoint, I think we are driven more by, I would say, sort of economic rationale than a particular application segment logic. I don't think at this point in time we are thinking about sort of the next level of large investment, which is sort of 1,000 crore plus kind of a ticket size, which is what we did at Zone 4. I think for the next few years, the focus will remain on sort of relatively medium ticket size projects, which can be turned around quickly based on existing infrastructure, at the same time significantly accrue to the bottom line, right? I think that will be the sort of dominant focus over the course of next 2 to 3 years as we digest the capital expenditure that has been done over the course of last 2, 3 years. And as I said, no specific preference towards any particular application. It's about which are the chemistries where we have value chain integration, which are the chemistries where we see a little bit protected market in terms of trade flows and less volatility. And of course, the financial returns on this investment. That's what will dominantly drive decision making.
Understood. Just one final question on the, you briefly touched upon the tariff part. What are the levers we have? I mean, many of these products we already know who our global customers are and where they are, what is exposure and all. So what we can do in the next 3 to 6 months to what is in our control I just wanted to understand to mitigate these tariff related impacts.
To be honest, relatively limited things that we can do at an organization level. I think the only couple of levers that have worked for us and we continue to push that is sort of having the proactive conversations with customers to ensure that the relationship remains intact and the business remains intact where both sides have to compromise to some extent. And the second aspect is, I think the product portfolio, which is potentially re-exported out of US, I think there are strategic levers which can be applied to minimize the overall tariff impacts. Right? So these two levers, I think we have been deploying it over the last 3 months and we'll continue to deploy it over the subsequent 6 months to mitigate the impact.
Okay. Understood. Thanks, Suyog, and all the best for the rest of the year. Thank you.
Thank you. Ladies and gentlemen, we request you to restrict to 2 questions at a time, please. You may join back the queue for follow-up questions. We'll take our next question from the line of Archit Joshi from Nuvama. Please go ahead.
Hi, good afternoon, sir, and thanks for the opportunity. Good set of numbers, firstly, to start off with. So first one, just a near-term one. If I look at this quarter in isolation, and the 15-20 odd crore EBITDA impact that we had from the previous quarter, which I'm assuming that would have been a part of this quarter. If I just make a adjustment, the EBITDA number should be roughly in the range of 270 to 80 odd crores. Would this be like a steady state number, let's say a couple of quarters down the line, before our Zone 4 and PDA capacities commission?
I think I would avoid from commenting on exact numbers, but yes, I think the level of performance that we are seeing right now is what is reflected based on the current strategies that are deployed. So if we are able to maintain this level of volumes, these are the numbers that someone can assume as a steady state numbers. But I think the objective is sort of not to stay here, right? I think both volume ramp up as well as the cost optimization efforts that we are doing right now should ideally start supporting the business further and potentially compensate for any more volatility that we might see from an end market standpoint, right? So I think from a existing business point of view, I think the quarter reflects a decent level of capacity utilization. But at the same time, I think there is still significant work left on the cost optimization as well as further volume ramp up possible from existing capacities.
Sure. Noted, sir. Sir, second one on the PDA expansion, I believe might be an opportune time to make PDA, given that we have an anti-dumping duty placed on Prettilachlor. I believe that would be the end product application of PEDA. Sir, we also had similar initiatives taken earlier from the ethylation unit for S-metolachlor earlier. Are we having any targeted approach towards agriculture given the family of products is similar? And do we have any export opportunities also in PEDA? Since I was just going through petolachlor's market, it doesn't look like it's a big market in India, roughly 1,000 odd tons, and we already have one competitor with roughly 8,500 tons of capacity of PEDA. So could you explain the rationale and the supply demand in the end product, which is petolachlor? Thanks.
No, so I think, first of all, I think the market is much larger as far as our understanding goes. If you look at the entire value chain, because India imports 3 different stages of value chain in this particular product, right? We import DIA, we import PEDA, we also import petolachlor. So I think the imports happen at 3 different stages. But I think beyond that, at AIL, we always look at opportunities from a global point of view. I think we enter into a product where we feel we can have global competitiveness and we can have a global scale play. This is one value chain where we are developing end-to-end integration. So we'll start from all the way basic petrochemical building blocks and we'll go all the way downstream. And we also feel that we will be able to do this with a distinctive competitive cost advantage. So that's the logic which we are deploying. So yes, it's a broader value chain play and targeting to build sort of globally competitive presence in that particular value chain.
Sir, any rough working that we could have on PEDA regards to economics around it, be it margins or revenue potential?
I won't share product specific numbers precisely for the reason that it's a value chain play. Right. So we don't look at it as a product. We look at it as a value chain starting all the way from aniline to ethylene. And some of it will be a part of existing business. Some of it will be incremental.
Sure, noted. Lastly, if I can just have one more. On the Zone 4 CapEx commissioning that starts from Q4, and then you mentioned that there will be about 5 blocks that will get added sequentially. How do we look at these blocks, sir? Because you mentioned 5, so I'm assuming 5 to 6 multi-purpose plants, but any block dedicated towards a particular chemistry or a product just to understand a little bit more of nuances on this with regards to its application area or any industry exposure that it could have. And given that we had also spoken quite a bit on CDMO opportunities, Aarti is also targeted to meet those kind of demand that can come up in the future. Any color on this would be helpful. Thanks.
So I think so not all of them are multipurpose blocks. The first unit that we will commission in the next quarter will be a multipurpose unit. Beyond that, the blocks are sort of chemistry oriented blocks, without getting into too much technicals, but it's kind of a photochlorination block, hydrolysis block, nitrilation block. These are the kind of chemistry block which allow us to make any product using that particular type of reactions, right? That's how the blocks are designed for, which will get sort of sequentially commissioned. There will be different products that can be produced from these blocks, which will have to be optimized on a time-to-time basis based on what is the margin profile and demand supply profile for these products. That's one. Sorry, what was your second part of the question?
The CDMO bit.
CDMO,
I think it's been quite some time since we have had our contract.
I think so. We've started our work in that dimension. I think we have good initial success. But I think currently where we are is we are getting to know and build relationships with some of the global innovators. I think that's where we are as we speak. I think we are doing 3 or 4 projects which are at kind of R&D level. So I think the focus remains on building relationships with global innovators and trying to get involved in a very early part of a development cycle. That work is going on well. That work converting into a large scale business in terms of manufacturing or supplying of a particular intermediate / chemical. I think that's kind of a 18 to 24 month journey in our sense.
Sure, noted. And sir, must admit the quality of disclosure and communication has improved significantly. So thanks for that and all the best for ensuing quarters.
Thank you.
Thank you. We'll take our next question from the line of Rohit Nagraj from 360 ONE Capital. Please go ahead.
Thanks for the opportunity. First question is on the M&A strategy. Earlier we had indicated that since we have a large presence established in the Middle East, we'll go for U.S., given that U.S. is a gasoline market, whereas Europe is a gas oil market. Now there is a change because of the U.S. tariff situation. Obviously, we did not anticipate that. How do we look at it from a change in strategy perspective and the benefits that we were likely to get accrued from U.S., would it be in similar quantum if we change the strategy to Europe and further into Middle East? Thank you.
I think the thesis still doesn't change. I think U.S. still remains the largest gasoline market. I think we won't be able to change, that thesis/facts because it's natural. I think it is the biggest market for gasoline. Yes, the trade barriers did impact, sort of our strategy in U.S. And in that context, we had to figure out some alternate market where I think the teams have been able to do a decent job. But we continue to focus on U.S. I think we will also see resumption of volumes going to U.S. In this quarter, despite tariff uncertainty. So that gives us confidence that in the long term, as the India-US trade deal stabilizes, I think potentially it will remain one of the most important market for this product. At the same time, we continue to develop globally because it's a product, as we say, is high potential product. So the market efforts to develop markets across regions, including Europe, including Middle East, including Africa, they continue to remain on track.
Sure. Second question, just bookkeeping question. This year our CapEx will be 1,000 crores. What will be the likelihood of CapEx for FY 2027 and similarly a tax rate for FY 2026 and 2027? Thank you.
So CapEx for next year will be substantially lower than 1,000 crores. We don't have the right numbers. We are still yet to work out the numbers, but it will be substantially lower. On a tax rate, I anticipate FY 2027 we should be somewhere between at a number below 15%. FY 2027 we should be between 15 to 20%. That's a rough estimate right now.
Fair enough. Thanks a lot and all the best.
Thank you. Next question is from the line of Aditya Khetan from Smith's Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Sir, first question on the DCB, we are witnessing a quarterly jump despite muted uptake in dyes and polymers. Any specific reason, like other segments where we look NT, NCB, all have been muted, that is understandable, but on DCB we have seen an uptake. Any specific reason, sir, despite end users remaining muted?
No, so I think on a DCB, you have to look at it both on quarter-on-quarter and year-on-year numbers. I think if you see year-on-year numbers, they will actually be negative. But quarter-on-quarter numbers are positive because the first quarter was actually very weak for DCB chain. And it's also one of the chain which did get impacted because of US tariffs. But I think we've revised our strategy for DCB. And that's one chain where we expect sort of very strong second half. So you will see volume growth in that particular segment, irrespective of what happens to US tariffs over the course of the next 2 quarters.
Okay. Sir, onto the MMA, when we look in this quarter, like the contribution from the energy segment is around 43%. Considering we are doing some debottlenecking and taking it to around 3 lakh tons, you see like the contribution to be around the 50% from energy segment. And does this pose any risk to our long-term spreads per kg or spreads per ton, like what Aarti used to enjoy earlier, spreads per ton, that will be materially lower if energy segment picks up more from the current levels? Any thoughts on this, sir?
So we don't actively, frankly, at this point in time, we are not actively managing exposure to a particular application segment, right? We have certain assets and we have certain capability. Right now, the focus remains on how do we sort of utilize these assets to the best possible extent to deliver the best possible financial performance. As I mentioned in some of the earlier conversations, the contribution levels at a broader portfolio level across applications have started to converge. Now, they will get reset over the course of next 1 to 2 years, and we do that optimization on a dynamic basis. But ultimately, the objective will remain that sort of how do we maximize the net contribution for the company across different applications while utilizing all of our existing assets. On a steady state basis, again, we mentioned it previously, we feel, given the entire Zone 4 new capacity, new products will also come on stream over the course of next 1.5 years. I think the energy as a segment, ultimately might settle down somewhere in the range of 30 to 40%.
Okay. Sir, just one last question. Sir, onto the US tariff, we have indicated that there was no pain we have witnessed in this quarter. You see any significant dip in volumes from the US market in next quarter, and materially we could be lower from this quarter?
No, I think we did witness pain from the US in this quarter. I think our share of US business in the last quarter was significantly lower compared to Q1. So there was definitely a pain. I think it was offset by push in the other geographies. So I think, but potentially to the level where we have already reached, I think the further downside is sort of can be arrested. In fact, there could be a positive trigger if we get sort of stabilization in the India-US trade deal.
Any tentative figures, sir, of the volume loss or the revenue loss from US?
There is no revenue loss because I think that volume has been actively placed in the other markets.
Okay, got it. Thank you, sir.
Thank you. We'll take our next question from the line of Abhijit Akela from Kotak Institutional Equities. Please go ahead.
Good afternoon. Thank you so much. Just with regard to the cost-cutting part of the guidance that we've spoken about. So this 150 to 200 crores is now mentioned as fully completed. Is this completely in the base in terms of the P&L numbers that we see, the expense numbers, or is some benefit yet to flow through in coming quarters?
No, there's a lot of benefit yet to flow through, especially, one of the major item there was around sort of renewable power purchase agreements. A large chunk of it is expected to get commission only in April 2026. So that is a significant benefit that will flow through in the next financial year. And there are also certain long-term contracts for raw material where sort of new pricing formula gets set in. I think those are also yet to flow through to the bottom line completely. So in terms of actions, I think the activities have been completed, but from a benefit point of view, there is a decent chunk of it which is yet to flow through in the bottom line.
Any sort of numbers you could put around that? How much of this 150 to 200 is in the base versus how much we should expect next year?
Difficult to say. It's also a continuing journey, right? I think we had given a number of 150 to 200 crore for which I think the action is completed. I would say roughly 40 to 50% of it is yet to flow through in the bottom line. But given it's an ongoing journey, we hope to also continue to add more initiatives to that funnel. And to some extent, it's also volume linked, right? Because many of these are variable cost reduction initiatives. So ultimately, if the rupees per kg cost is down, as we increase the volume ramp up, automatically the cost saving benefit also gets multiplied accordingly.
Got it. Thank you. And just one other thing on the tariffs. Any color if you could please put around the sort of conversations that customers are having, US-based customers, regarding maybe the sharing of the pain, So, I mean, is the tariff burden basically being shared? How are things evolving on that front and how you see them going forward?
I think in near term, it's in the interest of both sides to figure out a workable model. But at the same time, we remain sort of cognizant of the fact that, if the situation doesn't get resolved, then there would definitely be some long-term impact. As we see, based on the current situation, it feels like China has a preferred trade arrangement even than in India in today's situation. We hope that will change very soon. But so far, I think we have been able to hold on to the conversations, and I think all the customers also remain sort of actively engaged. But yes, people will look forward to getting clarity over the course of next few weeks to ensure that they lock in their plans for the next year.
Okay. Got it. Thank you so much and all the best.
Thank you. We'll take our next question from the line of Vivek Rajamani from Morgan Stanley. Please go ahead. Vivek?
Hi, sir. Thank you so much for the presentation. Just a couple of clarifications on the tariff bit again. I think you mentioned that you've already reduced the share of volumes to the U.S. This quarter and offset it with sales to the other regions. So would it be fair to say that if this tariff situation resolves whenever it does, the volume impact may not be significantly high because it could just be a case of you moving the volumes to the U.S., or there could still be a more improved volume performance should that happen? That's the first bit. And second, if you could just also touch upon, X of tariff, the volumes going to the U.S., do they have a better margin profile vis-a-vis your volumes going to the other geographies? Some color on that would also be helpful. Thank you so much.
The answer to the second question is yes. I think X of tariffs typically, we've enjoyed better margin profiles in U.S. than other geographies. I think the first part of that question, the answer sort of changes from value chain to value chain. So if you look at, something like MMA where, if you're operating at, 90% plus capacity utilization, then opening of US market will not change the volumes. It might change the margin profile, but it will not change the volumes because anyways the capacity utilization is to a decent level. But there are some other chains like phenylenediamines, like DCB, like ethylation, where the capacity still exists. So I think opening up of US market or making it more sort of accessible based on reasonable tariff arrangements will help us also push incremental volumes.
Sure, sir. That's very clear. Thank you and all the very best.
Thank you. We'll take our next question from the line of Surya Narayan Patra from Phillip Capital India. Please go ahead.
Yeah, thanks for the opportunity, sir, and congratulations for the great set of numbers. My first question is on the, let's say, the MMA. So, within a year, you are just almost like tripling the capacity. Can you give some sense what incremental confidence that you are having on this product segment? And now with the diversification, whatever that we have seen from the GCC market to other, so what is the split between GCC plus other for MMA currently?
So I think overall we remain again very confident about the market potential of the product. That's the reason further debottlenecking efforts underway to increase the capacity. From a regional share point of view, at this point in time, we would not address it because right now it's frankly driven a little bit by the current geopolitical situation that we are facing. I think we will reach to a little bit stable global footprint position in, let's say, 6 months down the line, where we have a resolution on the US-India issues. At the same time, we have good feedback from current expansion activities that we have done in, let's say, Europe, Middle East, and Africa. So we'll reach a steady state potentially 6 to 7 months down the line. But the only thing we can say is that we do have a presence practically in sort of all major blending markets in the world.
Sure. Second question is on the upcoming projects which are likely to drive profitable growth for you the way that you are indicating. So any of the upcoming projects, whether it is the multipurpose plant or the PDA or the other set of projects, so any of them, whether that has been backed by a customer and hence the implementation of those projects or execution of those projects would not be deferred or delayed?
I think we've moved past that industry phase, to be very honest. I think there are very rare instances where these are kind of sort of back-to-back customer committed with take or pay kind of contract kind of commitments projects. Yes, in all of them, we do have very active conversations with customers and we do have decent relationships and conversations in place, which gives us confidence to place the molecules But if your question is specific to that, whether we have a take or pay contracts for any of these products, then the answer is no.
Okay. Okay. Sir, even then, can you give some vision, because this multi-purpose plant is a kind of a project which can encompass so many projects, but we may not be having any sense about it. So just to, since it is coming in the fourth quarter and it would be very much there in next year and following year, as a kind of earning driver for the company. So if you can give some color to it, that okay, how things will really shape up for this project, that would be helpful.
So I think, PEDA is a classic example of MPP, right? We saw the opportunity in the market. I think sort of 80-90% infrastructure already exists in terms of multipurpose plant, and you have to do sort of final tweaking to get the asset ready to sort of deliver on a certain product in a certain value chain. Your time to market goes down significantly. I think the way we look at MPP is a flexible asset which reduces our time to market for new innovative products significantly. So it's been looked at as a capability rather than necessarily, as a NC or as a net contribution engine. Once we get into the market, stabilize the product, we have two choices. Either we can continue to manufacture that in sort of one of the NPP setups, or if the volume sort of ramps up and we see significant market development, we could potentially also build the dedicated, assets for ramped up chemistries. So the way we look at MPP is a tremendous capability which accelerates time to market and at the same time gives us opportunity to try out innovative products at a lower cost.
So is it fair to believe that, sir, the vast R&D capability and investment what you have already created, so this MPP is a forward integration to those R&D capability?
Yes. So I think that's where CDMO efforts will also come into the play, because if you look at the overall pipeline that we have built, right, we have a great R&D setup. We have now 2 world-scale pilot plants which have already got commissioned. Then we have a multi-purpose plant which was kind of a missing piece in the overall chain, and then we have a dedicated chemistry block. So I think our ability to serve global partners across the different stages of development and different stages of a market product evolution is going up phenomenally with this asset addition to our capability.
So, sir, just one bookkeeping question for Chetan, sir. Sir, you mentioned that there is a 34 crore kind of forex loss sitting in the finance cost line. So this 34 crore is excluding that 15 crore forex loss number that is there in the line items.
Yeah.
Am I right?
Yeah.
Okay. And
sorry, go on.
Yeah, please, sir.
Yeah, so 34 crore is related to the long-term ECB which was taken from IFC, and the 15 crore comprises about the impact on the short-term working capital export finance like packing crate and other stuff which is taken. It actually also gets netted off against the positive benefit on exchange, which is part of revenue from operations to the extent of around 25 odd crores.
Sure. Okay. So then, when this 2-3 project that is going to be commercialized in the second half, what is the kind of a spike in the finance cost that we can see on a quarterly basis, or in whichever way that if you can give some clarity? That is one part. And also if you can just give the export number for the quarter.
On the finance cost, there will be some increase which will come through because this project will also start kicking in. The initial period, the contribution to EBITDA would be quite limited, and there will be working capital which will go through. I don't have a right number in terms of what is the increase in the finance cost which should assume. I'm also anticipating a bit of softening of interest rate going forward. So that should support in terms of not moving the finance cost significantly up. On the export numbers, I'll probably come back to you.
Sure, sir. Thank you. Yeah, wish you all the best, sir.
Thank you. We'll take our next question from the line of Tushar from Omega Portfolio Advisors. Please go ahead.
Yeah.
Good afternoon, sir, and thank you for the opportunity, and congratulations for a great set of numbers. Sir, I just wanted to know, in the MMA, which is contributing around upwards of 40%, will that maintain going forward? That's the case, that's the first thing. And secondly, sir, we are very confident on the MMA. Just wanted to know our right to win in India, in the global market, in the MMA business.
So I think from a manufacturing point of view, we feel we have one of the largest and sort of most competitive capacity for this product. I think there are several innovations that we have done on technology front, which also allows us to sort of play in this market against competition. And third, we are genuinely investing a lot in building a supply chain infrastructure as well as creating very deep customer relationship with the large global players. At the same time, on the volume confidence, I think the confidence of manufacturing and placing the product is sort of demonstrated also in the quarterly performance. At the same time, we have to understand that there is an economics linked to global oil and gas sector trends, and a certain support from differentials available for gasoline and differentials available between gasoline and naphtha do have a fundamental impact on the demand for this particular product in the global markets. So with the understanding of that context, I think we still continue to remain excited and we continue to expand both market as well as our capacity.
Fair enough, sir. And sir, in the agrochemical, considering the second order effect, do you see the agrochemical global picture in terms of volume is improving going forward?
So I think at a global level, volumes for sure have seen some recovery, but the margin pressure remains quite intense. I think if you look at India's specific picture, we are starting to see some second order impact of some of our downstream customers who are exporting to US. I think some impact was visible in the last few months. But at the same time, I think so everyone is hopeful of settlement on that issue and sort of the long-term issue of inventory-linked pressures, which were having overall impact on the consumption or the volume growth itself. I think those are sort of mostly settled.
Got it, sir. And sir, in terms of your margin profile, this 14% margin, do you see the structural one going forward, or it just depends on the price movement in terms of the margin?
No, I think, as I said earlier, I think for us right now, the biggest needle mover is the operating leverage. So if we are able to, maintain and sustain the volumes at this level, then the operating leverage kicks in. But however, I have to also admit that the volatility in the market, both in terms of raw material and the product pricing, still remains at a very elevated level. In the last 6 months, we have seen significant volatility in raw material, and that also corresponds to product prices in a lot of other segments. So we remain watchful of that. But I think at a generalist answer level, the current volume levels will support, the operating leverage-led increase in the margin.
Okay, sir. That was really helpful. Thank you, and all the best.
Thank you. We'll take our next question from the line of Siddharth Gadekar from Equirus. Please go ahead.
Hi, sir. So first on the chlorotoluene project, can you just highlight what is happening there and when do we expect a ramp up in that project?
I think I answered it partially. It's part of our Zone 4 blocks. And, as we start the next financial year, you will see sequential 5 blocks getting commissioned in Zone 4 over the course of full financial year. And, all of these blocks are designed and able to produce chlorotoluene value chain at the same time many other products. And we will select the products depending on the market dynamics and the contribution possibilities.
Okay. So secondly, just on the MMA competition, can you highlight what kind of capacities are we seeing getting added in India and China?
I think exact numbers, frankly, are not very specifically available in the market. We suspect there is sort of another 100 plus KT capacity available in India and maybe 200 to 300 KT capacity available in China. Though that's not reflected in the volumes from competition, but that's the kind of capacity that could be available.
Thank you so much.
Thank you. We'll take our next question from the line of Sajal Kapoor from Anti-Fragile Thinking. Please go ahead.
Yeah, hi. Thank you for taking my question. First up is just an observation. The quality of communication and disclosures have improved significantly in recent quarters, Gio. So well done on that front. Even if you read through the annual report, the disclosures have significantly improved. And that's one. And then we have stepped up our efforts in science and innovation. The intellectual property creation effort has increased. All that is good. The question I have is in an increasingly uncertain and random world. How do you see the balance sheet position? Would you be comfortable with the current debt profile we are carrying on the balance sheet? And what is the plan to sort of try and maybe deleverage amid the current wave of capex, plus the fact that the next wave of capex will be much more focused on fungible, more science and innovation-led capex. So the capex is an ongoing effort. What I'm slightly concerned about is the current debt levels that we have on our balance sheet.
Thank you, Sajal. I think first on the capex side, I think the capital execution strategy has been very disciplined for last 12 months and will remain very disciplined going forward. I think in some of the questions I did cover that. I think in going forward also, if you look at next 2 to 3 years, I think we are not looking at a very blockbuster kind of a capex, right? If something comes our way, we will of course evaluate and sort of come back. But at this point in time, the focus remains on sort of medium scale capex, which are able to turn around very fast and are able to deliver significant returns utilizing existing infrastructure. So that remains primary focus. And that will also help us manage the overall balance sheet much better. We actually think from a debt to EBITDA point of view, we potentially could have already seen the peak. So we don't sort of, absolute debt numbers are important, but for us, I think what we track more is debt to EBITDA. And I think on that front, we feel that we could have potentially already seen the peak now, and it should improve going forward.
Okay, that's helpful. That's all I wanted to check. Thank you.
Thank you. Next question is from the line of Anil Chaurasia from Smith. Please go ahead.
Hello, sir. Congrats on good set of numbers. I have just two queries. One, sir, what explains the increase in debtor level almost by 65%?
So if you look at the top line has also gone up, and in certain cases, for some of the, in fact, just adding it to the previous question which was there, the export percentage is upwards of 60%, where the credit profile is a bit more as compared to the domestic numbers. So which is where you would see this receivable to be there. So if I combine on an overall working capital basis, the working capital cycle continues to remain at the level what it was. It continues to remain in a range of around 45, 50 odd days. The receivable plus inventory continues to operate at a similar level. So there's a reduction in inventory days, increase in receivable days because of the fact that the export profile has gone up a bit.
Okay. And secondly, sir, in cash flow, I think you were explaining that actual finance cost is 159 crore. But if you look at in cash flow under financing activities, we have reported only 115 crore. So what explains the difference?
So as I said that there is the mark-to-market impact on the loans, which has to be accounted based on the volatility of the currency, is not a cash flow item. And that is where the cash flow will show the actual cash outgo versus the P&L will reflect the provisioning for those potential volatility impact as well.
So you mean to say last year there was no such item like mark-to-market?
Not
last year it was matching?
Not significant.
Okay, sir. Thank you so much, sir. All the best.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to management for closing comments. Over to you, sir.
Thank you. Thank you everyone for joining us today. We appreciate your continued support. As shared earlier, we are transgressing across the most challenging phase of the chemical sector. I think our resilient and robust strategy helps us navigate this phase and deliver growth and sustainable performances. We hope we have been able to address all your questions. Please feel free to reach out to us if you have any further queries. Thank you once again.
Thank you. On behalf of Aarti Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.